In November 2021, a company that had delivered fewer than 200 cars in its entire history was worth more than Ford Motor Company. Lucid Group's market value hit $89.9 billion, surpassing Ford after a 24% single-day run-up in its stock price. Analysts were calling it the Tesla killer. Hedge funds were piling in. Retail investors were mortgaging their futures on a car most of them had never seen in person. At its absolute peak, Lucid's market capitalization reached $90 billion in November 2021. Then it evaporated. By late 2025, Lucid's market capitalization had shrunk to $3.56 billion, a 98% crash from that $90 billion peak. And as of May 2026, it sits at roughly $2.18 billion. That is $88 billion gone. And here is the part that will haunt you. The car was real. The technology was genuinely extraordinary. The people building it were some of the most talented engineers on the planet. None of that mattered. This is the story of how Lucid Motors became the greatest financial illusion in modern automotive history. And it starts with one man who spent a decade trying to prove something to his former boss. His name is Peter Rawlinson, and before anyone had ever heard of Lucid Motors, he was the man responsible for building the car that saved Tesla. Rawlinson served as VP of Vehicle Engineering at Tesla and Chief Engineer of the Model S, leading its engineering from a clean sheet of paper to production readiness, while simultaneously building a world-class engineering team. He had previously worked at Jaguar, Lotus, and Chorus Automotive. He was, by any measure, among the best vehicle engineers alive. But something about Tesla felt unfinished to him. The company's culture was moving fast, cutting corners on refinement, chasing volume at the expense of the premium product he believed the technology deserved. So in 2013, he walked. He joined a small EV battery supplier called Atieva, and under his leadership the company evolved from an EV battery supplier into a full-fledged luxury automaker, which it renamed Lucid. The vision was precise and uncompromising. Rawlinson did not want to build an affordable car. He wanted to build the finest electric vehicle ever made. He wanted to do everything Tesla had done, then do it better. More range, more power, more luxury. A car so good that the market would have no choice but to respond. It was an engineer's dream. And that, in ways he would not fully understand until later, was also the problem. When the Lucid Air was finally revealed to the world, it did not disappoint. The Dream Edition R became the first electric car in history, with an EPA estimated range exceeding 500 miles, rated at 520 miles on a single charge. The Air's closest competitor, the Tesla Model S, featured an EPA range of up to 405 miles and a peak charging speed of 250 kilowatts. The Lucid Air charged at 300 kilowatts, meaning it could recoup 300 miles of range in roughly 22 minutes. The Dream Edition performance produced 1,111 horsepower against Tesla's Plaid at 1,020, and it reached 60 miles per hour in under 2.5 seconds. It won the 2022 Motor Trend Car of the Year, beating 24 competitors from major manufacturers, including Mercedes, Porsche, and BMW. It was, objectively, the most advanced electric sedan on the planet. Rawlinson had done exactly what he said he would do. He had out-engineered Tesla. The performance data was real. The awards were real. The enthusiasm from the automotive press was real. And on Wall Street, the hype machine went into overdrive. What nobody asked at the time was a very simple question. Can they actually build enough of these to matter? If you want to understand how a $90 billion company collapses, you need to subscribe now and stay with us, because the next chapter is where it all starts to crack. The year was 2021, and the financial markets had temporarily lost their minds. SPACs had dominated initial public offerings, accounting for 63% of the almost $77 billion raised on US exchanges, and there were nearly 400 SPACs active, with more than 100 preparing for IPOs. Every investor with a brokerage account wanted the next Tesla. Every blank check vehicle was hunting for the startup that would deliver it. Into this environment, Lucid walked with its stunning car, its world record specs, and a deal with the Saudi Public Investment Fund already locked in. Churchill Capital IV's share price surged more than 300%, after Bloomberg reported it was in talks to merge with Lucid. Before a single production car had been delivered to a customer, traders were pricing Lucid as a generational technology company. Rawlinson told investors he believed Lucid could eventually be valued like Tesla, and the market, drunk on zero interest rate money, decided to get there immediately. The surge in Lucid stock even brought it close to eclipsing General Motors, which had a market cap of $90.9 billion at the time. A company with 125 delivered vehicles was within touching distance of a 114-year-old automaker, producing millions of cars per year. The valuation was not based on revenue, profit, or production capacity. It was based entirely on the belief that Rawlinson's engineering genius would translate directly into market dominance. That belief was about to be tested. The first cracks appeared quietly. Lucid had promised 20,000 vehicles in 2022. Instead, Lucid slashed its production outlook to 12,000 to 14,000 vehicles, citing extraordinary supply chain and logistics challenges. But the details behind that cut were revealing. Rawlinson said the problems were more to do with commodity parts such as glass and carpet, rather than an ongoing global shortage of semiconductor chips, glass, carpet. The most technologically advanced electric vehicle on Earth was being held up by components you could buy at a hardware store. This was not a supply chain story. This was a manufacturing philosophy story. Rawlinson had spent years perfecting every inch of the Lucid Air, obsessing over tolerances and materials and finishes that no competitor matched. The car was extraordinary precisely because the standards were impossibly high. But those same impossibly high standards are now applied to the factory floor, where hundreds of workers are trying to hit production rates that the entire production process had never been designed to achieve at speed. Building 10 perfect cars is a craft project. Building 10,000 perfect cars is an industrial operation. They are completely different disciplines, and Lucid had only mastered one of them. The market noticed. The factory in Casa Grande, Arizona was a genuine engineering marvel. But marvels are slow. Lucid produced 7,180 vehicles in 2022 and set a 2023 production target of 10,000 to 14,000 vehicles, roughly half the 20,000 to 22,000 deliveries analysts had expected. Of those 2022 vehicles, only 4,369 were actually delivered to customers, meaning a significant portion sat in inventory, undeliverable, because the software was not finished, or the configuration was wrong, or the final quality checks were failing. Meanwhile, each car that did leave the factory was costing the company a staggering sum to produce. The Wall Street Journal reported that Lucid was losing $227,802 per car sold. That is not a typo. For every vehicle a customer drove home, Lucid burned $227,000 more than it received. The company was generating revenue, yes. It was simultaneously detonating its own cash reserves with every single delivery. By 2023, the situation worsened. Production slipped from a peak of 3,493 vehicles in Q4 2022 to just 1,550 in Q3 2023, and Lucid revised its full-year target down again to between 8,000 and 8,500 vehicles. Every downward revision crushed the stock further. Every earnings call became a negotiation between management's optimism and the raw arithmetic of a company burning through billions to make cars that fewer people were ordering. Then the world changed. Through 2022, the US Federal Reserve raised interest rates at the fastest pace in 4 decades, responding to inflation that had been building since the pandemic. The era of free money that had inflated every speculative tech valuation, including Lucid's, was over. Money had a cost again, risk had consequences again. And a $150,000 electric sedan with a 2-year waiting list suddenly looked far less attractive in a world where borrowing money to finance it cost real money. Simultaneously, Elon Musk made a decision that directly targeted Lucid's addressable market. In January 2023, Tesla began slashing prices across its lineup, in some cases by 20%. The Model S, Lucid's most direct competitor, suddenly became dramatically cheaper overnight. Consumers who had been considering a Lucid Air ran the comparison again and found a very different calculation. Lucid's pre-order reservations for the Air fell from 34,000 in Q3 2022 to 28,000 by February 2023, a loss of 6,000 potential customers in a single quarter. The demand that Wall Street had priced in at $90 billion was evaporating, and there was nothing in the engineering specs that could stop it. The Air was still the better car, the market no longer cared. Let's look at the actual numbers, because they tell a story that no press release could soften. Lucid's loss from operations in 2022 was $2.6 billion. In 2023, the net loss deepened to over $2.8 billion, the fourth consecutive annual loss and the steepest in company history. In 2024, Lucid's operating loss reached $3.02 billion on revenue of $808 million. To understand what that means in practical terms, Lucid was spending roughly $4 for every dollar it brought in. The factory was running, the cars were beautiful, the press reviews were glowing, and the company was financially disintegrating with every vehicle it shipped. The cash burn was only sustainable because of one entity that refused to stop writing checks. Saudi Arabia's Public Investment Fund had been the original savior of Lucid back in 2019. After the SPAC, after the crash, after the production disasters, the Saudis kept coming back. The sovereign fund put a further $2.5 billion into the company in 2024, bringing its total outlay to $8 billion for a 58.4% stake. Then in 2026, they injected another $550 million. The math became almost absurd. PIF and its affiliated entities have committed approximately $9.5 billion to Lucid, which is 3.75 times the company's current equity value. The Saudis were not investing anymore. They were keeping a patient alive. By early 2025, the architecture of the company had changed in a way that could not be undone. Peter Rawlinson resigned as CEO and CTO in February 2025, stating only that it felt like the right time following the launch of the Gravity SUV. He left with a $120,000 monthly advisory payment and a $2 million stock grant, a gilded exit from the company he had spent 12 years building. The stock dropped immediately on the news. Bank of America downgraded Lucid and slashed its price target by 2/3 the same day. What remained was a company that had produced roughly 9,000 vehicles in 2024, was burning over $3 billion a year in operating losses, and was now controlled by a foreign sovereign wealth fund that owned nearly 60% of its shares. Lucid's market cap sat at approximately $2.53 billion, while PIF's cumulative investment had reached $9.5 billion. The Saudis had invested nearly 4 times what the entire company was worth, and speculation about whether PIF would eventually take Lucid private entirely had become a permanent feature of every analyst note and investor forum. The independent technology company that was going to dethrone Tesla had become a dependent project of a Gulf sovereign fund. That is not a failure of engineering, it is a failure of everything else. So what is the actual lesson here? Because Lucid is not a simple story of fraud or incompetence. The people involved were genuinely talented, the product was genuinely exceptional, the technology was, and by many measures still is, world-class. The lesson is that markets do not reward engineering. They reward scale, speed, and profitability. Tesla did not win the EV era because it made the best car. It won because Elon Musk was willing to make an acceptable car at enormous volume, cut prices aggressively, and build a manufacturing machine that could survive losses long enough to reach unit economics that worked. Rawlinson prioritized flawlessness over throughput, and the factory reflected that choice at every level. The second lesson is about the SPAC era specifically. Lucid had a market capitalization of $90 billion in November 2021, despite having delivered fewer than 200 cars. That valuation was not an assessment of the business. It was a bet placed in a zero-interest rate casino, and when the casino closed, the chips were worthless. Every startup that went public via SPAC during that period faced the same reckoning. Lucid just had further to fall. The final number that tells the whole story. The Saudi PIF has now spent $9.5 billion on a company currently worth $2.18 billion. The perfect machine is still running. The business case never quite arrived,